Principles of Finance with Excel Modeling. Copyright Lou Gaddis. Topic 3, Computing Enterprise Value and Equity Value. In this topic, we're going to learn about how to calculate the enterprise value, but let's talk about what we've learned so far. In the preceding topics, we forecasted free cash flows and the cost of capital for a firm called the WACC, a weighted average cost of capital. In this topic, we'll combine these two concepts to compute the fundamental firm value, also called enterprise value, and the fundamental stock price. The enterprise value is the theoretical value of a firm's total operating assets. The fundamental enterprise value is equal to the present value of free cash flows to the firm discounted at WACC. Enterprise value is considered the takeover value of the entire firm. The fundamental stock price is the enterprise value minus the net debt position, which is debt minus cash. The fundamental stock price is used to determine if a stock is a good investment. In other words, is the fundamental stock price greater than the market price? And in this topic, we're going to compute the enterprise value and fundamental stock price for whimsical toenails. That's the example from the Benninga textbook, and discuss capital structure and market efficiency. Lastly, we're going to create a user-defined function using VBA. So here are the steps to estimate the enterprise value and equity value of a firm. Step 1, you want to estimate the enterprise cash flows, also called the free cash flows to the firm. Now, the free cash flows to the firm from topic 1 are the earnings before interest and tax, subtracting out tax by multiplying times 1 minus the tax rate, adding depreciation and subtracting CapEx. Remember that we called the addition or the net of these two effects the net CapEx. In other words, if the CapEx is equal to depreciation and the sum of those two numbers there is 0, that means you're just replacing the assets. Your capital expenditures are just equal to the depreciation next year, that year. If the net CapEx is positive, you're actually increasing the capital stock in the company. You're growing the asset base, and that would be characteristic of a growing firm. Lastly, you subtract the changes in non-cash working capital. Second step, estimated enterprise discount rate, and we've done that, the weighted average cost of capital. Third step, compute the fundamental enterprise value, which will be the present value of all free cash flows discounted at the WACC. That should give you a value today of all the operating assets. Now, if you're looking for the equity value or stock price, we will take our enterprise value, we calculate it in step 3. We're going to subtract out our net debt by subtracting debt and adding cash, and divide by the number of shares outstanding. So this is our roadmap for where we're going to go today. Let's go look at the model we created in topic 1. In that model, we had actual financial statements for whimsical. We then forecasted based on our value drivers and our financing policy. We forecasted our sales, our top line, down to our net income. We forecasted our balance sheet, including equity, liabilities, and assets. We then used those numbers to calculate a working capital that allowed us to get to the free cash flows to the firm. We then estimated some profitability ratios. The important one we're going to use today is we estimated dividends per share. And we estimated some growth rates and some other ratios. Now the model from topic 1, I'm going to make a small change in that I am going to switch from making cash a policy variable there to making cash a plug. Now on topic 1, we focused on using goal seek. So if I go to data, what if, goal seek, what I could do is ensure that the balance sheet balances by making sure the difference between L&E and assets is 0 by changing either debt, stock, or cash. However, I'm going to make a change. I'm going to make the only two policy decisions, changes in debt and changes in stock, that balance the balance sheet. And how I'm going to do that is I'm going to make cash a plug. So instead of making this a policy variable, I actually created a circular reference by saying cash is equal to my total L&E, liability and equity, minus net fixed assets minus current assets. Now, normally that would create a circular reference. That would create a circular reference because cash drives interest income, which has an effect on net income over here, which has an effect on additions to retained earnings, which has an effect on equity. In other words, total L&E, which would then affect cash. So you can see that cash has a if I set it the way I have, it will create a circular reference. How I solve that is you can ask Excel to try to solve a value for cash to solve this equation. And by going to File, Options, Formulas, if I enable iterative calculations, and I'd only do this if I know I want to create a circular reference that I would like Excel to solve. If I do this, Excel will solve all circular references. So let's take a look. If I go to my policy variables here, I'm going to make a little reference right here. I'm just going to say equal, and over here it tells me the difference between assets and liabilities and equity. So you can see my balance sheet is balanced, just because I have a reference of that. Now, if I say I'm going to take $800,000 reduction in debt, what happens is my cash balance just shrunk and my debt balance increased, and the cash became the plug. It figured out how much cash was needed to get the balance sheet to balance. Or I could reduce equity by, say, $100,000. If I do that, notice I have a formula built in here that if I buy back $100,000 worth of stock, I have an assumption that the stock price is $10 per share. The shares shrink by 10,000 shares. What you'll also notice is the cash plug changes and stock reduced by $100,000. So I have this model set up that I have an iterative calculation such that the cash becomes a plug and the balance sheet were balanced based on my value drivers. So that's the model we're going to start with. So the first thing we're going to do is let's just try to directly calculate the value of the stock using a different model called the dividend discount model, the DDM. Now the DDM equity valuation model states that the fundamental stock price, my estimate of the value of the equity, is the present value of dividends discounted at the cost of equity. And if we assume that dividends grow forever at a constant rate, we can use the constant growth perpetuity formula to compute the present value of an infinite series of cash flows. Now the present value of a constant growth perpetuity is equal to the cash flow received at the end of the first period divided by the discount rate minus the infinite growth rate. So that cash flow, that first cash flow, is the one you receive next period. Now it's important when we're using the growth perpetuity formula on a cash flow, you have to ensure that the infinite growth rate that you assume is no larger than the growth of the economy. Because if you assume that the growth of the cash flow is going to be greater than the growth of the economy, you are then forecasting that that cash flow will be larger than the economy at some date. So the general advice is you never want to have that growth rate greater than your estimated growth of the economy. And we're talking about nominal growth of the economy, means it includes inflation. Now, a rule of thumb is that's probably going to be less than 4% for the U.S. So I'm saying it's going to be a maximum of about 4% or approximately 4%, because the growth of the nominal growth of the U.S. economy is comprised of just inflation, which is running between 0 and 2%, population growth, which is running, say, 0 to 1% long term, and increases in productivity, which is about 0 to 2%. So that range of long-term growth of the U.S. economy looks like it's going to be between 0 or a max of, if I add these up, 0 to 5%. However, we use about a maximum of about 4% as the growth of the U.S. economy. Also, as a proxy, this is suggested by Aswath Damodaran. If you're looking for a proxy for the growth of the nominal growth of the U.S. economy, just look at the yield of long-term bonds, which are about 1.5% to 3%, looking at, say, 10 to 30-year bonds. That's also kind of an upper range of what that long-term growth rate should be. So let's go ahead and do a dividend discount growth or dividend discount model. We have some parameters here. The current stock price is $10. Risk-free rate is 5%. Market risk premium is 8%. My unlevered beta, I'm just making an assumption that my unlevered beta for this business is 1.19. That would be the beta if this firm had no debt. And let's say a cost of debt is 10%. Now my net debt from my model, the current net debt is the total value of debt minus cash is $2.4 million. Let's calculate the market cap of equity. The market value of equity, got $10 a share times 1 million shares currently outstanding. That's 10 million value of equity. If I take my equity value divided by my equity value plus debt, I have 80.65% equity. 1 minus that is my value of debt, which means my debt to equity ratio, if I'm 19% debt and 80% equity, is 20.24 DDE ratio. In other words, 24% financed, or a ratio of 0.24. Now my tax rate was 40%. Now we can calculate a levered beta. If the beta of the firm would be 1.19 without any debt, I can multiply that times 1 plus the DDE ratio times 1 minus the tax rate. And I have a levered beta of 1.37. Now I can use CAPM to calculate the cost of equity for the firm. Cost of equity from our CAPM model is our risk-free rate plus our levered beta times the market risk premium. So I got a 15.92% cost of equity. All right, so now I have cost of equity. I've forecasted that this firm's going to have a dividend per share of 99 cents, and that's from my forecast of net income divided by number of shares outstanding. So that's down here in my spreadsheet. So I have a link to it up here. And let's assume that cash flows grow forever at 2%. So this firm's dividends are going to grow at a little less than the growth of the economy. Then I can say that, well, if I take using my growth perpetuity formula, take the cash flow next year, divide it by the discount rate. Now in this case, I'm going to use the cost of equity. You cannot use WACC when you're using equity cash flows. Dividends are simply equity cash flows. So when I take the present value of equity cash flows, I'm going to discount them at a discount rate that captures the risk of equity only, which is cost of equity, minus my constant growth rate. So this says the stock is worth $7.09. The current stock price is $10. It doesn't look like a great deal. But let's do some sensitivity analysis. Let's say that the growth of the dividends between -1%, and let's go a little more aggressive. Let's go all the way up to 4%. I'm going to take this up to 4%. And using a growth perpetuity, using a data table, I can put in a bunch of values for one parameter. I can put a link right here to a formula that uses this parameter, which is my fundamental stock price. Now I can highlight this range, go to Data, What If, Data Table. Since the growth rates are in a column, I'll click on Column, click my growth rate that affects that fundamental price. And here I have a range of prices. So it looks like if all the other factors are correct, and the growth rate is between -1% and 4%, the stock is worth between $5.83 and $8.28. So it doesn't look like a great deal. So that's how you can use the dividend discount model. Now the problem with this model is it doesn't focus on all the cash flows that the shareholder receives. So for one thing, a disadvantage of a DDM, dividend discount model, is many U.S. stocks pay no dividends, therefore should have no theoretical value, unless you, say, forecast dividends in the future. Also, the dividend discount model doesn't account for capital gains of the stock that are driven by cash flow growth. So the idea that the firm is getting more valuable because it's acquiring assets, not because it's paying dividends. So what we're going to do is we're going to use an enterprise value model to value the equity by focusing on cash flows and not dividends. So again, we're going to estimate the enterprise value by estimating free cash flows, compute the WACC, and they get the fundamental enterprise value, the total value of the total firm's assets, will be the present value of all those free cash flows discounted at WACC. And then the fundamental stock value is the enterprise value minus net debt. And if I divide by the number of shares outstanding today, that gives me the fundamental stock price. So let's do a whimsical free cash flow valuation. So let's start with the free cash flows I've estimated for 1 year, $2,228,000. Again, that's from my model from topic 1. Let's again assume it grows at 2% forever. All right, that's just a guess. Now I'm going to take the present value of a series that starts at 2.028 million, grows at 2% forever. The present value of that is that cash flow divided by the discount rate. Since these are total firm cash flows, that's what free cash flows of the firm are. I'm going to use a total firm WACC minus the growth rate. So what we see now is we need to come up with a WACC. Now I think I have all the information I need for WACC. My WACC is going to be my equity percent times my cost of equity plus my debt percent times my cost of debt, that was an assumption, times 1 minus the tax rate. So I got a WACC of 14%, which gives me the total enterprise value, the value of all the firm's assets. If I bought the firm, paid off all the debts, partially using cash, and collected all the cash flows, I'd be willing to pay $16,902,000 for this. If I then take that value, subtract out the net debt position, current net debt position, that gives me an equity value of $14 million. Divide that by the current number of shares outstanding today, 1 million. That says I should be willing to pay $14.50 per share for this stock. That's the present value of the firm's cash flows available to the whole firm, both equity and debt holders, but then subtracting off the current claims from debt. That gives me an equity value of $14 million. Divided by number of shares, I should be willing to pay $14.50 per share. All right. So that's our first free cash flow valuation model. Now the problem with this model now is if we go back to the assumptions on whimsical, we're forecasting the firm is actually going to grow, the revenues at least, 10%. And if I look at my compound growth rate at the bottom here of free cash flows, well, I didn't calculate. Let's calculate that now. Well, I don't have the growth of free cash flows. We'll just say the top line growth was 10%, bottom line growth was 10%. So what you'll find is free cash flows are probably growing at about 10% a year. My assumption is that growth is going to slow immediately to 2% a year. So this is kind of actually a conservative estimate to come up with 1450. Whenever you're growing faster than your perpetual assumption, what is recommended is you do something called maybe a growth ramp, or called an end stage growth valuation model. And that model is going to be this. I'm going to assume that my firm is going to pay, or is going to generate cash flows of $2 million next year. And I know in perpetuity it can only grow 2% per year. That's my estimate. What I can then just is create a growth ramp. I'll get from last year's growth of about 10 down to 2, and I'll just do it based on my judgment that it'll go down 2% a year. So in other words, that cash flow, it grows by 1 plus that growth rate. And then that continues until I get to the point where it's only growing at 2%, and then we can say it grows at 2% forever. So this are now my free cash flow estimates for the next 5 years. I can then take the present value of all free cash flows discounted at WACC. I'm going to do myself a little favor here by using a named range. Let's call this cell. I'm in F15. Come over to my cell reference. I'm going to call that WACC. WACC, and hit enter. Now I can always reference that cell by using the name WACC. So what I can say is the present value of $2 million divided by 1 plus WACC raised to the 1 power. I would pay $1.8 million for next year's cash flows. I can then copy that down, and this is the present value of the next 5 years' cash flows. If I sum this up, that would be the enterprise value if the firm died at the end of year 6. It was closed down, it was worth nothing. This would be the value of the firm. Looks like it's about $9 million. However, I'm not going to assume the firm just falls apart at year 6 and there's no more cash flows. I'm going to make the assumption that it grows at 6% forever. So at the end of year 6, that's the value of just the cash flow in year 6. And then I'm going to say, well, what's the value of the firm from year 7 to infinity? What I'll do is I'll do a growth perpetuity. I'm going to take that year 6 cash flow plus the year 6 cash flow times 1 plus my perpetual growth rate. That would be the year 7 cash flow. Divided by WACC minus perpetual growth rate. So now what this is here is the present value. It's the present value of the year 6 cash flow plus the year 7 cash flow over WACC minus G. So that's the present value, it's the value of all cash flows from year 7 to infinity. However, when you apply a growth perpetuity formula, it gives you the value in the year before, not necessarily the value in year 0. Now, if I'm using free cash flows in year 1, the growth perpetuity gives me the value in year 0. However, if I'm looking at cash flow in year 7, it gives me the value of the cash flow in year 6. So I need to take the value, that growth perpetuity, and divide by 1 plus the WACC to the 6th power. If I now sum all that up, that's the present value of all future cash flows. I get $18,986,000. Now there's one other way to do this calculation. It's a little bit easier. Well, I don't know if it's easier, but it's a little shorter. Once you know a cash flow grows forever at a certain rate, I could just do the growth perpetuity here without dealing with year 6 cash flow. I could just take the year 6 cash flow. Since I know that cash flow grows forever, I can just divide by by WACC minus the perpetual growth rate. All right, that would be the value of all cash flows from year 6 and on. And it'll give me the value in year 5. So I can take that whole value and discount it for 5 years. That'll also, that's a discount it for year 5, so that's a take it. Take that growth perpetuity and divide by 1 plus the WACC raised to the 5th power. Now that also gives me my 18,986,000. So let's talk for a little bit of time about why I discount it to the year 5. Whenever you use the growth perpetuity formula, it actually gives you the value in the period before the first cash flow. So if we're using the free cash flow in year 1, it does give me the present value. However, if I use year 6 cash flow over K minus G, since this is year 6 cash flow, it gives it to me in year 5. To get back to the present value, I need to discount back 5, 4, 3, 2, 1. I have to discount back 5 more years. So I just divide that value in year 5, divided by 1 plus the WACC to the 5th power. So now I have my enterprise value using a growth ramp and free cash flows. If I take that, if I subtract out my net debt, that gives me equity value. If I divide that by the number of shares outstanding, 1 million shares. Today, how many shares today? That gives me 1659. So this is a free cash flow valuation model, discounting at WACC, computing the enterprise value. All right, the reason why the present value of free cash flows is enterprise value, not equity, is because these are cash flows available to pay both debt and equity. These are the cash flows that are generated by the assets, not affected by debt. So that's the total value of the assets. Subtract out the net debt, that's the total value of equity divided by number of shares. That's the fundamental stock price. Now this thing looks like a pretty good buy. The stock is trading for $10. You think it might be worth $16.59. Now I'm going to do one other valuation model that's very common. It's actually probably more common than how we finished off this valuation. So it's going to look a lot like the old model. Actually, let's make a link here. The free cash flow is going to start off at 2.028 million. I'm going to have that grow at 8% per year, then 65432. And then I'm going to take the present value of cash flows, 1 plus divided by 1 plus WACC to the 1 power. Copy that down. All right, so it looks like the same model so far, except the only difference, if you look at it, is this one cell we're going to change. A common way, there are 2 common ways to finish off a valuation model for an infinite series. One way is doing a growth perpetuity using an infinite growth rate. However, the problem is the model becomes very sensitive to changes in that infinite growth rate. Another way to do it is to, instead of using a growth perpetuity, just calculate your cash flow in year 6 and multiply it times some constant. That'll tell you the value of the firm in year 6, and then discount that back for 6 years. And how you get this constant is use something called, say, a cash flow multiple. You look at firms, say mature firms in your industry. Now, why I'm looking at mature firms is I'm estimating this firm is becoming mature. And if I look at mature firms in your industry, what if you found out that on average they sell for about 7 times free cash flows? So all the firms you consider have the same risk as you in your industry, on average sell for today for about 7 times their free cash flows. Well, you can use that in your model. That the value of the firm, the terminal value we call it, the final value, is going to be that final cash flow times my price multiple, 7. So the firm is going to be worth 7 times free cash flows. Take the present value of all cash flows, and I get 1754. Well, got a slightly different number here. Let's take a look. Well, that looks good. So I'm taking my free cash flow in year 5, multiplying times my multiple, and dividing it by 1 plus WACC to the 6th. All right, looks like I might have discounted that one down to the 5th, so this must be an error. All right, now let's talk about the one reason why I make that error is if I copied that formula down and I discount it to year 5, the cash flow multiple is not a present value concept. Well, what it's saying is just firms are worth roughly, in this case, 7 times their cash flows at any period of time you look at. So if we're looking at period 6 cash flows, we'll just discount it at periods or something. Yep, it'll give the value in year 6, so I'll just discount it at year 6. Now the only thing I'll mention is I've seen it one other way, and that other way is sometimes firms will do, or firms that do valuation will calculate that last cash flow, then add the multiple. So then add, so again, I just had the present value of the year 6 cash flow. And then what they do is add on top of that, it's going to, at the end, it's worth 7 times free cash flows, and discount that back at WACC raised to the 6th power, 1872. Oh, actually, it looks like that's what I must have done in that last model. So those are 2 different ways to finish off a growth or a terminal value using cash flow multiples. And again, I've seen it both ways. So the question is, do you kind of, in some sense, double count this cash flow? That I'm going to take the present value of that cash flow, and then the future firm is going to be worth 6 times that cash flow. So I guess we'll go with this method for now. Just got to be careful, and every model is going to be a little different, and you get a slightly different valuation just because of that one cash flow. So there's my valuation. Now we can do a 2-factor data table by varying WACC and price multiple and see what kind of range of valuations I get on this stock. So I have some WACCs plugged in here, 10 to 18, stepping by 2, and price multiples of 4 to 10, which is kind of a common range. They're probably more in the 6 to 10 range. If I just make a link to the equity value, highlight this table, data, what if, data table. My input on the row is WACC. Click on WACC. My column are a series of price multiples. There's my price multiple. There's my 1872 because I used WACC of 14 and price multiple of 7. And it gives me a range of prices. Looks like between about $13 and $26, all of which are higher than the $10 market price. So it looks like the stock's a pretty good buy. So there's our model for estimating the value of a stock. Now I'm just going to talk a few minutes about a couple other things. One is free cash flow valuations and capital structure. Now the mix of debt and equity instruments used to finance a firm is called its capital structure. Now managers select capital structure to maximize the value of the stock or the value of equity for its owners. Now I want to do a couple things. Let's verify that my 2082, that's my free cash flow there, that does not change even if I change the value drivers for equity. So actually here's a link right here. All right, 2028. Notice if I pay down debt of $800,000, free cash flows are unchanged. Free cash flows of the firm. If I buy back $100,000 of stock, free cash flows are unchanged. All right. So you see that free cash flows to the firm are unaffected by capital structure, right? Because free cash flows of the firm are cash flows before interest payments. However, there is an effect on WACC. All right. So if I were to, let's go have one where we Well, let's go ahead and decrease debt by $1 million in year 0, and we'll see what happens to WACC. Well, actually, instead of that, let's go to the next slide. I have a model built for us. Let's go to this capital structure to minimize WACC. So what we learned from this exercise here is that capital structure has no effect on free cash flows, but it is going to have an effect on WACC. Right? So again, if I reduce my debt by $800,000, all right, it has no effect on free cash flows. But if I were to reduce debt today, that's going to affect my DDE ratio, which is then going to affect things like my beta. And what will happen is my cost of equity is going to change. And also, you would think that the firm got riskier by, say, or less risky by changing debt. You would think that debt holders would demand a different discount rate or a different return. So let's think about that. What if I were to increase debt in a firm and use that cash generated by the debt to immediately pay a dividend? So in other words, I'm increasing the value of debt, but cash is unaffected because I immediately pay it out as a cash dividend to the shareholders. Nothing in the numerator for the valuation. This is a one-stage growth, free cash flow in the numerator, WACC minus G in the denominator. So this is the value of the firm. We've determined that increasing debt is going to have no effect on EBIT, the tax rate, CapEx, depreciation, or working capital. So that becomes unaffected. The risk-free rate is unaffected. The unlevered beta, the basic business risk of the firm without debt, is unaffected. What is affected is it's going to increase the DDE ratio, which will increase the levered beta and increase the cost of equity. However, the share of equity and debt will change, right? If you increase debt, my E% will go down and my D% will go up. My growth is unaffected. Now, the only question is what happens to cost of debt? Right now, I have it modeled as it's just 10%. So if I increase my debt, what's going to happen is we're not going to exactly sure what's going to happen because my D% is going to increase, my E% is going to decrease, and my cost of equity is going to increase. However, it makes no sense probably to not think about what's going to happen to the cost of debt. As a firm increases debt, right, the DDE ratios are going up, your times interest to earn ratios are going to go down. It's just going to be a riskier firm. Investors that loan money to you, either through buying bonds or giving you loans, are going to demand a higher cost of debt. So I have a little model set up here that to maximize the value of a firm, changing capital structure, it doesn't affect cash flows. So to maximize the value of the firm, all you have to do is try to minimize WACC. So here I have this is close to whimsical here. I have their market price of stock, risk-free rate of 5%, market risk premium of 8. I put an unlevered beta of 1.19. I put a tax rate of 40%. And let's say the DDE ratio is equal to whimsical's DDE ratio. And that gives me a WACC of about 14%. Now I made a big change here. I just tried to come up with a stylized, in other words, kind of a very simple model for cost of debt. Let's assume the cost of debt is equal to the risk-free rate plus 10% times the DDE ratio. So it's the idea that investors in your bonds want at least the risk-free rate plus some compensation for how risky you are. So we'll assume that they want 10% times your DDE ratio. That gives me a 7.45% cost of debt. That gives me a 1369 WACC. What I can do is run Solver. Now you have to go make sure you have the Solver add-in by going File, Options, Add-ins, Go, and make sure you have Solver. So now I'll go to Data, Solver, Minimize, click on Minimize the WACC by changing the DDE ratio. Solver found a solution. Looks like you can get down to 1357. That's what we would call, in this very simple model, the optimal capital structure, the capital structure that maximizes the value of the firm, which means, in our model, minimizing the cost of capital. Now, I just did a data table here. DDEs of 0 to 90%, or 0 to 0.9. And I showed the WACC. And what you see is the WACC at this point here. If you have zero debt, your WACC is almost 15%. As you increase your DDE ratio, take on more debt. Now what's happening here is the initial stage, cost of equity, if I start with a DDE of 0, my cost of equity is almost 15%, and my cost of debt is 5%. So by having a little bit of debt, my DDE, I'm going to decrease my WACC because I'm using that cheaper source of funding. And why debt is so cheap is debt is safer at this point because it's a fixed cash flow with a firm with very little risk. However, when my DDE goes to say 0.3, that's even better. I'm moving down this curve. However, at some point, say the DDE is 0.8, my cost of debt is now 13%. And what's happening is that the reason why it's first getting better is you're using your cheaper source of funding by increasing your cost of debt. You're also maximizing that tax benefit, the tax shield of using debt in financing. So that's good. However, at some point, the effects of leverage offset that tax benefit of debt and that initial cheap debt when the firm was safe. So you have this optimal position here. Now, every firm is going to have an optimal DDE ratio based on how risky their firm is and their basic business risk. This firm has an optimal DDE of about 0.4. So we can do that optimization one more time. Solver, minimize WACC by changing DDE. And it looks like it was a DDE of 0.4%, which means using 28% debt and 71% equity in financing. So in this topics, we've calculated the value of equity, and we talked about we can estimate the value of equity and then decide whether a stock is undervalued or overvalued. A good stock buy would one in which your enterprise value and then valuation of equity is greater than the market price. In our model, we estimated that Whimsical is possibly undervalued. Therefore, maybe we should buy it today. The problem with using fundamental analysis, that's what we call this. Fundamental analysis is looking at the fundamentals of a corporation, estimating cash flows and a discount rate, estimating a value of a firm. That fundamental value, there's evidence to show that that's not really going to help you form a better portfolio and buy cheap stocks. There's sufficient evidence that stock prices reflect all publicly available information, like all the information we got from the internet. And the average investor cannot consistently pick undervalued stocks and otherwise beat other investors' estimates and beat the market. So there's lots of evidence that professional equity investors, buyers of stock, people that run mutual funds, do not consistently beat, say, just the S&P 500, just a simple market value weighted portfolio. So it implies that technical analysis just means using price charts and finding price patterns, and fundamental analysis, estimating cash flows and discount rates, is quite useless. However, some people hold out hope because of people like Peter Lynch that ran Fidelity's Magellan Fund that beat the market 13 straight years, that they say, well, it just takes someone that's really smart to beat the market. Although people would say, well, Peter Lynch, a 13-year winner in the market, isn't necessarily proof. And they use an example that if you took 10,000 monkeys and had them manage your portfolio, and every year estimate it or see how many monkeys beat the market. On average, you say half the monkeys would beat the market, half the monkeys would not beat the market. At the end of 13 years, if you would count how many monkeys beat the market 15 straight years, you'd almost be guaranteed that one monkey would have to beat the market 13 straight years. So the question is, Was Peter Lynch smart, or was he just a lucky monkey? So in this topic, we first started by using the free cash flows and WACC we calculated from topics 1 and 2. We then calculated the enterprise value by taking the present value of free cash flows to the firm discounted at the weighted average cost of capital. And we looked at capital structure. How can we increase value by changing the DD ratio, the mix of debt and equity in a firm?